Welcome to the Retirement Planner Podcast, a podcast that brings clear guidance to help American families like you to navigate the journey from savings to spending in retirement. I'm your host, Don Chamberlin, a certified financial educator, and my mission for over 2 decades has been to educate and help Americans throughout our great country about their retirement planning goals. With each episode, we will tackle subjects such as Social Security, taxes, market protection, everything else you need to know to retire with peace of mind. No financial jargon, just straightforward education and real-world wisdom to help you build the retirement you've worked so hard to achieve. Join me as we explore how to help you make your money work as hard as you have. So hello again and welcome back to the Retirement Planner Podcast. I'm Don Chamberlin, and on our last podcast, we talked with John Del Greco and got a great idea of how holistic planning was envisioned and came to be over his 47-year career in the financial services industry. So if you didn't watch the other podcast, John is a partner with C2P Enterprises, a company in 2011 that actually pioneered the concept of holistic planning, as well as a concept called the bucket plan that now we see many other companies starting to use bucketing. But back when I saw you guys with that and starting that, I had never heard of bucket planning in the way that we're doing it now, John. So he's an originator of that. He has a great family business. He has 3 of his sons in the business with him, and just a wonderful guy. So welcome back again, John. We're happy to have you, and we're going to talk now about safety in retirement. So this is a big issue with the volatility in the market and people getting concerned. Events kind of this year with the whole thing with tariffs and everything have gotten people up in arms about what might happen to the stock market or the economy or inflation increasing. And so let's talk about what you do in that arena. What do you try to do to help people in advance of because they can plan right now for it, certainly, but we've already seen some effects of it. So what do we try to do before to plan for it when we're thinking about these things in advance of someone retiring?
I think a big part of it, Dawn, is when you meet these people, preparing them with a lot of questionings. Most of the people that come to me are people, they're primarily blue-collar people, all right, that didn't make tons and tons of money in their lifetime. You know, I do a whole lot of business in rural communities outside of Pittsburgh. And a lot of these people, safety has been something that they've always looked for with assets that they've had. And a lot of times prior to meeting us, that safety was driven to them through banking vehicles.
Yeah.
CDs, money market, checking, savings accounts. And when we discovered that, it was a wonderful way for us to pivot and show them what the benefits of annuities could do in that same space, to make sure that they were going to maintain their safety, maintain their principal, and then we would show them over time what CDs, savings accounts have done. And we aren't in the era of the CDs and savings accounts that were back in the 80s when they were 9 and 10 and 11%. I mean, just up until the last couple years, we went through a period of 10, 12, 15 years where we had people that came in that had 200 grand in a savings account and they were earning 0.2%.
Right.
0.2%,
Yeah.
right? And so when we seen that, we were able to show them the ability that annuities bring
Yeah.
as opposed to what CDs bring. And let me tell you the other thing with annuities. They have beneficiary driven contracts. And you know how important to avoid probate.
Mm-hmm.
If you have CDs, if you have savings accounts, and you haven't been educated to name beneficiaries on them, which I have found most people are not
No.
educated. So they're titled assets. They're titled assets that when they pass away, they got to go through probate.
Mm-hmm.
They got to go through the local court, get an attorney, pay a fee, wait for time. Our annuities name a primary and contingent beneficiary. In the event of a death, the money is to the person that's in line like this. I tell you a wonderful story. I had met a guy years ago, and he was a farmer out in Smithton, PA, and got in front of him, and he had a ton of money in banks, in the local banks. And I tried and tried and tried, and I gave him the benefits and the reasons,
Mm-hmm.
and we talked about probate, and we talked about, and finally, I said to him, because I had learned, I didn't pick up on it originally. He was a very, very private person,
Oh, okay.
and had four children. All right. And I finally, one time when we were talking, I said, "Do you know?" His name was Chester. I said, "Do you know when you die?" And his wife had already passed away. All of this money in these annuities are going to be recorded in the courthouse down in Smithton.
The money in the
And
CDs, you mean? Yeah.
in the
When it goes
CDs,
through
yeah,
probate, right?
goes through probate. And everybody you liked and disliked is going to be able to go down to that courthouse and find how much money you
Right.
had and who you left it to. And he looked at me. And then I said to him, "Hey, Chester, when I drove up to your house today, outside on the door, it didn't say I had $1 million in this account, 800,000 in this, 500,000 in this." I said, "Why?" He said, "Because it's nobody's business." I said, "Well, when you die, it's everybody's business." All right. The reason he went with me was because annuities avoid the probate process and they're not public record. And that's something we don't talk about.
Right.
We
Right.
don't talk about the benefit, but many, many people, buddy, are very private and don't want that knowledge to be disclosed at their death. And on top of their ability to not lose money, on top of if you have bonus driven products or not bonus driven products, that money that gets credited never ever goes away dependent upon something that they can't control. And every year on their anniversaries with these products, every year, if there's a credit to be given, it's given, added to the existing account, and now that's the new number going forward. And the peace of mind that brings to blue collared people that have struggled all their lives to earn money and save money. There's nothing that compares with it. Mutual funds don't do it. Stocks don't do it. CDs do it in a way, but nowhere near. And I didn't even talk about this. What about the CDs taxable income?
Right.
You don't need, if you don't need that, you're still taxed. In the annuity, I know you have, and I know I have a lot of people that we've created products for that were not bucket plans where we needed income. We replaced CDs and savings accounts for the ability to be much more competitive going forward. And a lot of them
Right.
don't need the income. A lot of them don't need the income right now, at least, right? And so the income grows with all the taxable event. In the event of a death, and most of their spouses are the beneficiaries, it passes to the spouse 100% with no taxable implications. What products do that and protect the money on a day-to-day basis? We had people that we've done bucket plans for that when this last week or so had occurred with, especially last week, right? Michael came in on last week, uh, Saturday. Saturday came in. I don't know how many, we had 30, 40 of those people, right? He called each and every one of them. And let me tell you what each and one of them said. We're not even looking at the stock market. You've provided a plan that's providing us with income, in this case 9 more years, 8 more years, whatever the time frame was that we created. We know we know that money will come back, and we don't have to depend on it or use it. So the annuities, buddy, provide that ability that no other products do. No other
Right.
products come close to it. Do you know, in the old days, buddy, in your, when you did the mutual funds, you'll remember this. Remember they had the rule of 8%? If you had $1 million, the investment people were telling the retirees, well, we're comfortable giving you 80 grand a year. And we think we're going to be able to get 20, 22, 24 years with the market. Then a couple things happened. Oh, then they went to the 6% rule. Now they're at 4 and 3% rule.
Right.
Right?
Right.
They're at 4 and
Well,
3% rules because of
four
this.
is pretty standard. Yeah, everybody thinks about the
Yes.
4% rule, but when
Right?
we have these low interest rates, there are articles in several different media outlets saying it's 3% or below now. So you just you
Yes.
can't count on that with the volatile up and down markets. So what you're really saying, John, is we have a 3 bucket approach where we have your liquid money in one bucket, we have your income money in the middle bucket,
Income. Yes.
and then we have the
Yes.
growth money, which is usually the majority of your assets, in a different
Yes.
bucket. So in the soon bucket, what we can do is we can have things that are safe. We can, which are, like annuities that fit in there, CDs. You could do some laddered bond for can I say it? Portfolios.
Portfolio.
Yeah, yeah. Uh, but in general, bonds are going to go up and down with the market, right?
With the market.
With interest rates. So back in 2022, bonds were down 18%. So we can't count on that as a guaranteed asset class. I want to share a story with you because you were talking about that one gentleman, Chester, and his
The farmer.
yeah, the farmer and his safe assets. Because this happened last year, and in our office we have a hallway, and on either side we have offices where some of our holistic planners are meeting with clients all the time, and there's glass walls there. And a lot of times, if I have extra time, which I don't have a lot of, and I see clients in there, because we're a national firm now, I don't get to meet all the clients. So if someone's in the office, I like to knock on the door and go in and say hi. And so I saw a holistic planner there, one of our better ones, and he's talking to this client. And I knock on the door, and I go in and I say, "Hi, I'm Don Chamberlin," and just to introduce myself as the founder of the company. And I look at him and I'm like, "I know you." And he said, "Yeah, you did a plan for me 4 years ago. So I'm not really meeting with any of the clients anymore because I'm the CEO full time." And he said, this is actually back in 2022 when that market did go down. The bond market went down 18%, the stock market went down 18%. And he said, "I'm moving to Dallas." I'm like, "Why are you moving to Dallas?" "Well, my grandkids live there. We're buying our dream house and we're retiring." And he said, "I'm so grateful to you." And I'm like, "Okay, why, why are you grateful to me?" He said, this is when we wanted to do it. And without the bucket plan, without that middle bucket that has the safe assets in it, because the market's down this year, we wouldn't have felt comfortable retiring if we had to retire, if we had everything in the market like we did before we met you. And so now we can retire, we can
How
move to
wonderful did
Texas
you feel?
and get the dream home that we've always wanted to have. And so that just make me feel so good about we can do that for
What you
a
do.
family, right? Let's go back to a little bit bit of basics. What is your definition of an annuity? How do you describe that to people?
You know what I tell them, Don? I look at it as an annuity is a vehicle that is issued through an insurance company
Right,
that has the ability to earn interest, protect principal, and dependent upon what the need is of the client,
right.
either provide guaranteed income through an income rider with an income stream or withdrawals dependent upon times that we need them.
Mm-hmm.
But I stress the importance of it being issued by an insurance company because they have the ability to provide all these guarantees around these products.
Right, right,
And they guarantee principal. They guaranteed whatever the return was that they lock it in. They guaranteed that at death, the full value,
right.
the full value passes to the named beneficiaries. Uh, so I try to keep it simple like that, and I don't get into. Well, I sometimes, depending upon the client, I tell them they're the most financially strong companies in the world, in the whole world. If you look at their ratings,
Mm-hmm.
of the companies that we do business with,
Right.
because we have the ability to pick and choose, and we only use the highest rated companies, right?
Mm-hmm.
And you can repeat a story, Dawn. There have been there have been some insurance companies that have failed over our years that we've been in this business, but every single one that has failed have been bought and purchased by other life insurance
That's
companies
right.
so that never the guarantees inside those contracts were put at risk.
Well, there's been
Never
a
were put at
there's been a
risk.
lot more banks that have failed. And,
Oh my,
and, and I know in the
daily.
Great Depression, a lot of banks failed, but no insurance companies did. Um,
No.
really, what you have is they are some of the strongest because they have both side of the equation. They have the income coming in from life insurance and other products, medical insurance, disability insurance, to offset the ability to pay interest on annuities. So they have both sides balanced. And I always talk about regulations because we saw, particularly in 2008, we saw issues with the banking industry. We saw very bad issues with the stock brokerage industry. And back then, we had some big, like they thought maybe the government's going to go broke at the end of 2008, right? It was a scary time. But the insurance companies were still stable. They were the ones that were holding things up. And it's because they have a totally different capital structure. They're required to have, for every dollar of debts that they have to have a dollar of assets to back that up. And they're also not regulate. So the banking industry and the securities industry are regulated in one place at the federal level. Now there's also regulations, state regulators, but primarily they follow the federal regulations. For insurance, it's all on a state by state basis. It's still regulated. So there's 50 regulators in 50 states that these insurance companies have to set
To
up all
adhere
the
to.
regulations for to follow. So these are some of the reasons why. Because when I started doing this in 2002, we even did CDs for a while. Rates were high enough that CDs were something that people were looking at. So we had some of those available because those were guaranteed too. But what I found over time is that the annuities give more features. Usually the interest rate's going to be higher than what a typical CD will be, or you'll have the potential to get a higher rate with some of these indexed options that you can have with the fixed indexed annuities. Um, and so that's really been the thing that our clients have wanted. And particularly when we talk about baby boomers and especially Gen Xers, they're not really turned on in a big way by CDs. But if they can have something that's going to be safe for their income in retirement, so, where they can replace their paychecks, and when the market goes down, when their growth bucket starts to go down, this bucket does not go down. Because what happens what happens if everything's in the market and it's going down and you're taking income from it?
You're getting pounded.
Yeah, you may lose so much money, if particularly if this happens in the first few years of retirement. It's called sequence of returns risk. You might lose so much money from taking money out for income at the same time the market's going down that you might not have enough money to live if you reach your 80s or 90s. So that's what we're trying to protect against. We don't want any families to go through that.
Don, you said something really important that when people's income stops, you said that just a minute ago, right?
Yep.
So when a person that you're sitting in front of, he's gone from living on earned income to fixed income. Listen to me. They want us to have the same lifestyle. They want to have the
Right.
same lifestyle. So when we put a plan together that allows us to take certain amount of assets that are in market driven accounts, right? And put them in that soon bucket. Listen what we promised them. Listen, we promised them. We don't tell them maybe this is going to happen. We don't tell them if the market's good, it's going to happen. We don't tell them if something in Europe happens, oh, we got to change the amount of money that you get next month, next year.
Right.
We show them we got income for them for a specific period of time. And we're generally looking at 11, 12, 13 years so that we give that later bucket where all this other money that was in market driven accounts, we give it the ability to do what it has always done over time and grow, but never at the expense of providing income. That annuity in that soon bucket is the biggest part that brings freedom and peace of mind in retirement.
That's right. That's right. And then they still have the majority of their assets in the growth bucket where they have a
Yes,
potential
yes,
to outpace inflation better.
yes,
That
yes.
but they have that safety net where they don't have to worry if there's fluctuations in the market or the market's down for a I keep asking people, what happens? You're going to retire in 2 years or 3 years or 5 years or seven or whatever it is. What happens if we have a lost decade right when you retire? The period of
We
time
had one of
from
those.
from 2000 to 2009 when the market was basically flat and we had two major downturns. Do
Yes.
you have any stories from that time frame?
I have I had met a person when Zach first came into the business, Dawn. I had him send out a term insurance letter
Okay.
that showed rates of 10 and 20 and 30-year term. All right. Because a lot of the people were used to annual renewable terms.
Right.
And the 10, 15, 20s killed it,
Yeah.
killed it. So we had like a little example in there and they had something to send back. And we get a response from a guy up in Altoona where I do a lot of business. And he wanted to see us. And so I said to him, come on, I'll come up with you that day. And the guy's name was Dean Maccarell. Now, when I meet him, I think it's an Italian name because the last, that was LLE at the end,
Right.
right? So we go to the house, we shake hands, and I say to him as we're walking up the steps, now listen to me, we just met this guy. We didn't know him a minute before we walked in that door. I said, how nice is it? Three Italians are going to sit around the kitchen table and talk about insurance. He says, who's Italian? I said, well, Del Greco's Italian. I said, what about Maccarelli? He said, it's not Maccarelli, it's Machiavelli. He said, I'm French. He
Oh,
said,
okay.
but my wife's Italian. All right. So we get in there and we look at his term. We're able to do much, much better. And then I say to him, you know what? My business is I help people in retirement. He said, you're not going to believe this. I'm retiring. He said, and I said, he worked at the two local hospitals. He was a physical therapist.
Okay.
He said, and I've made a decision at the one, and I think he wasn't sure. So I said to him, listen, make sure that you can't get a lump sum from those options that they've given you, because I might have the ability to help you in a better way that they can with a guaranteed a life annuity where he loses the asset, right?
Mm-hmm.
So he said, I'll do that. We come back 4 weeks later, and he has a big thing on the kitchen table, and we talk and get done with all the life insurance, and then he says to me, "Oh, remember you told me to ask that question?" I said, "Yes." He said, "I had already elected income from both of them, which we know once it's done, it's irrevocable."
Right, right.
But he says, "I have an account." He said, and he's that big pile of paper on his desk. He pulls out a statement and he starts pushing it over to me. And I think it says like 80 something thousand dollars. It was $860,000 that he had in an IRA. All right. This was just before '08
Oh,
debacle.
wow. Yeah.
Just before. Listen, this was like in September, August of that year.
Of 07. Right, right.
Yes. He says to me, we talk about what we have the ability to do with annuities. I said, are you worried about maybe if a market comes down, you're retiring now? He said, I am. He said, what type of products do you offer? And we go through exactly what the annuity does. That day, he said, let's move it all. Buddy, listen to me. He has since passed away. He has since passed away. He ended up getting Lou Gehrig's
Oh,
disease.
dear. I'm sorry.
And we spent a lot of time together his last couple months. And in his state that he was in those last months, he never could stop thanking me for
Wow.
creating the safety with the annuities, because that 800 grand would have went to 450, and we would have never got it back.
Right,
Never,
right.
never, never got it back. And his biggest concern was his wife, Tina. And she has more than enough income and assets to live if she lives 30 more years. All right. And she's 75. And the feeling that we get from doing that, there's
It's
nothing that can
incredible.
replace that.
Right.
There's nothing that can replace that.
When you can help
So
people that
that was
way.
one that was timing. That it just the timing was perfect. We saved them $300,000-400,000.
Yeah. That's great, John. Thank you for sharing that story. Unfortunately, during that time frame, I had a lot of people come in to talk to us, and they didn't have that same situation. They didn't meet somebody like you before the market went down. Now, we helped a lot of people before the market went down, obviously in 2008, but we had a lot more people coming in that weren't prepared. I remember one particular couple, and Lucent Technology used to have a big facility here
Yeah,
in
I
St.
remember you
Louis,
talking about Lucid.
and Lucent would allow them to put in their 401k all Lucent stock. Lucent stock lost something near 90%. Um, Actually, this was the previous, this was in the dot-com bubble from 2000 2002 is when that happened. It wasn't the 2008, like you said. So and it's likely that people are more diversified today where that type of thing wouldn't happen. But we've got to remember, we've seen in this decade, we've seen those two big market downturns. We saw a lot of volatility in 2020. The market went down 35%. Then we saw the market down again 18% in 2022.
22.
So um, that volatility is not necessarily going to go away. I would say if you think the market's going to continue up for the rest of your life, that's your choice if you want to be in the market. But if you want to really have a balanced plan where you're not thinking about the market and having to talk about it. And I think maybe the worst thing today is just how the media blows all these things up and makes them news stories and makes people worry about it very much. So that interrupts a peaceful retirement for folks where they should be able to have time when they don't have to think about things. They've worked hard throughout their lives. And for the right people seeking a level of protection like you're discussing, I think really works. So do you have any last
You hit
thoughts?
it on
Go
the
ahead.
head,
Go
buddy,
ahead.
with
Finish.
balance. You hit it on the head with balance. We know that these products aren't for all your money. We know that. They're for part of your money that provide income and peace of mind and guarantees and protection of principal. And with those things in place, you have the ability to navigate retirement with a lot less on your mind on a daily basis when these things like we're seeing now happen.
I also did want to ask you, John, about some of the misconceptions about annuities. What some of these things are like, when you put money in an annuity, you'll never get it out. It's locked in. Annuities are very expensive. Um, they pay big commissions to advisors. Well, what are some of the things you think about when you hear some of these things?
You know, if they're ever brought up to me, I have an educated conversation with them, and I say to them, annuities back in 30, 40 years ago, they were different than the annuities that are being sold today. A lot of them back then were just annuities that provided immediate income. And
Right,
people had
right.
the fear that, oh, I gave this money and I gave up the
Yeah,
rights to
yeah.
the money. I only have
An
income.
immediate
Oh, we
annuity
don't.
where, yeah, you
We
don't
haven't
get any
sold one of
principal
them in
back.
30
Right,
years.
right.
Yeah. Yeah, they had big surrender charges. At death, they included the surrender charges.
Yeah,
That's not a part of the fixed indexed and fixed annuity space in the last 20 years.
right.
So a lot of that comes from um, internet misconceptions from other people, and all we have to do, Dawn, and you know this better than anyone, is listen to it and then show them what's fact and what's real, what's not real and what's fact, and then it's a simple solution. Yes,
Yeah, yeah. So, yeah, the liquidity thing is this is a situation where you still have your principal in the annuity. And there is liquidity depending upon the annuity company. Usually every year, a certain amount you
yes.
can take
Some
out.
even in the first year, some a lot of them. Yes, and a big amount of liquidity, a big amount of liquidity. Yes, and when we're doing our planning, buddy, we make sure that there's assets available for if they have liquidity. The annuity is there if they need it, but they also have other assets that if they had this. And that's in the now bucket with leaving the money for emergencies, for a wedding that's being planned.
Correct.
The annuity has its purpose, and there's no product that provides the purpose that the annuity
Right.
does.
You would never want to put all your money in the annuity. Usually, you don't
No,
want to put
heck
even
no.
half of your assets in an annuity. It depends on the situation, but that's the way we kind of look at it. And then there's this thing that annuities have big fees, right? So um, generally, that's a specific type of annuity. It's called a variable annuity. That that is a type of
Oh,
annuity that isn't guaranteed. Um, we actually have. What we call at our firm a variable annuity rescue program, where we do a full review on the annuity, if someone has it in place, to determine, is this still a good annuity for you? And we found those have 3%, sometimes as high as 4% fees a year.
4% charges.
Yeah,
Yes.
yeah, and um, when we do this, we're really trying to educate the client on what they have if they have a variable annuity. So sometimes what happens is there's a rider on there that you're paying a high fee for, but it's really valuable. Like a lot of these companies did promotions over time and they tried to give a benefit, and that benefit is kind of irreplaceable. So even though you have a high
Yes.
fee, you may not want to
Yes.
replace that annuity. You just have to
Replace.
look
Yes.
look at it correctly. And then the whole thing about they pay big commissions. Um, that is, I mean, it's all disclosed now.
Yes.
We have to tell you exactly what that's going to be, and it doesn't come out of your money.
Doesn't come out of your money.
If you invest $1 million into an annuity or make a deposit, it's not really an investment because it's not a security. You make a deposit into an annuity, um, that whole $1 million is there, and that's what you start with. And then you get all the
Yes.
benefits and the rates of that annuity. The We as financial professionals get paid out of the marketing budget from that annuity company
From your company.
to
Yes.
handle that. So those misconceptions will come up. There's a lot of people out there that don't like annuities because they would rather you keep your money in the market. And for certain people, that's great. Annuities are not right for everybody. But for a
No.
lot of people,
No.
we're finding they love the bucketing approach that we talk about. They love taking some of their money and putting it safe so that they can have income. Usually, like you said, we segment it for 10 years, 11, 12, 13 years, where they could have that income for the first years of their retirement, avoiding sequence of returns risk then for them during those years. So great. Any closing thoughts? I'm glad we got to that topic of misconceptions for
No.
annuities.
I'm glad I didn't, because I don't, I do what you do, buddy. I do reviews on variables. I don't represent them as a product
Right.
because it doesn't fit. But that was wonderful that you brought that
We
up.
just
And
find the fees. I mean, they're a good product for accumulation. We find, but when you get to retirement, having a fee of 3 or 4%. Imagine you're trying to take out 4% or 5% as income, and you have a 4% fee on top of that. Now you've got to earn 9% just to stay even.
just
So
to stay
we
even.
find in
Yes,
retirement they don't work as well as they could in the accumulation phase before you retire.
100%.
Well,
This
great.
was fun.
I really love this time with you, John, today to talk about these things. You have a great, distinct point of view on safety and retirement. And I've always really respected what you've done because of that. And so hopefully we'll have a lot of people having questions about this. And what I'd recommend for them to do is to go to our website, go to our learning center, educate yourself more on our learning center on that website, and you'll be able to discover more things about retirement. And that's the key to a great retirement, is learning what you need for yourself and your family. Thanks again to John Del Greco. If you really enjoyed this podcast, what we'd ask you to do is subscribe to the podcast, share it with friends. We're really trying to build a community here of great people that want to educate themselves and get better at retirement. And we'll be there to help you all along the way. So thanks again for joining us. We'll see you next time on the Retirement Planner Podcast. Thank you so much for watching the podcast today. Our mission is to bring an education-first approach to help countless families like you turn their retirement dreams into reality. Have specific questions about today's podcast? Do you want to learn more about our holistic planning approach? Click the button below to schedule a call with one of our financial educators. Subscribe to our podcast and share with others who could benefit from this episode. Check out our YouTube channel for more videos on this retirement planning subject. Also, follow us on Facebook, Instagram, and LinkedIn for all your retirement planning needs. Remember, planning for retirement is a journey, not a sprint. It's about taking those critical steps today to secure your future. Until next time, keep planning, keep dreaming, and keep moving forward on the path to your confident and fulfilling retirement.